And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it's the first week of March in terms of trading anyway. And of course, this is the beginning of the three strongest months of the year from a seasonally strength period, right? So we talk about, seasonality, the seasonally strong 6 months of the year, October, November, December, January, February, March. So, those tend to be the strong months. Of course, summer months tend to be weaker. And so we're entering into three of the stronger months of that seasonally strong period. So again, not surprising here. Markets are continuing to do well. As we talked about before, they're just a little bit advanced here. We'll get into some very kind of interesting details on some statistics here in a minute. Outside of that, though, not a tremendous amount going on now. We're pretty much wrapped up most of earnings season, so now we're going to really be focusing on economics. We've got a Fed meeting coming up this month, so we'll see what their next kind of tonation is going to be in terms of will they, won't they, when they, will they, cut rates. That's going to be the big question. And again, of course, with markets doing well, inflation kind of becoming a little bit sticky here at these levels, odds are that the Fed's going to kind of postpone cutting rates, at least at this juncture, which, may disappoint the markets. We'll see. Markets have been pretty much realigning themselves with the Fed. Remember, at the beginning of this year, the market was expecting 5 to 7 rate cuts. The Fed was saying 3. Now, that's pretty much been worked out. So the market pretty much agrees with the Fed now that we're going to get 3 rate cuts this year. But the question for the markets is going to be, what happens if we don't get a rate cut this year? What if rate cuts don't come until next year because inflation is a little bit sticky? How does that kind of jive with the overall market? So again, these are some of the things that we'll be watching here very closely here over the next few weeks. Of course, then we get right back into earnings season again in April. It's just just that quick. We finish one up, next one starts. Time flies when we're having fun. So again, this is going to be a kind of an interesting week. We've had a very strong February. Normally, February tends to be a weaker month. That was not the case this year. So the question becomes, do we get a little bit of weakness in March? We'll see. Statistically speaking, that's not generally the case. But, anything can happen, right? And particularly as we start to get closer to summer, and of course the pre-election. I've got an article that's coming out this week. I've got an article coming out on presidential election cycles, what happens during presidential election years, looking at kind of all the market stats around that. And it's interesting because there is normally a corrective phase to the markets before the actual onset of the election. So again, and that kind of brings up an interesting point, by the way. I was reading an article this morning that showed the average year. So when the markets are up 20%, in 18 weeks, the market tends to do better for the year. And of course, you take all the years that this has happened in the past, and then you kind of put a line in the middle and say this is the average. And so we look at the average as kind of a trend higher. But if you take a look at the underlying markets, there's always kind of corrections along that process. So once you average them all together, you smooth all the volatility out. Of course, that's what averages do. But again, when you take a look at these years, they can tend to be volatile, even though you wind the year up higher. So yes, we could very well finish this year higher than where we started that, but it doesn't mean that you get a bit of volatility along the way. So just be a little bit careful about that. That was something that we talked about in this weekend's newsletter. If you take a look at volatility, it's extremely low in the markets right now. And of course, that historically kind of precedes a period of higher volatility. Low volatility begets higher volatility, and that's just that corrective phase that occurs from time to time. But that really kind of is the environment we're in. We're very complacent. We're very bullish right now. No reason to be overly concerned with the markets at this moment, but just be aware that that low volatility is ultimately a risk that we'll have to deal with at some point. Okay, so here's what you need to know before the bell this morning. So I did a little bit of work over the weekend, just kind of looking at markets and what's going on. We touched on this in the newsletter, of course, and then I've got an article coming out on Tuesday talking a little bit more about this. But if you take a look at the market right now, we've now been up 16 of 18 weeks. And again, this has been a very low volatility move. As we talked about last week, you've been in a very narrow defined channel in this market. We just trade to the top of this channel, come back down, retest the lower end of this channel, which is right along the 20-day moving average. And we're creating this ever bigger divergence from the 200-day moving average. So again, just a very low volatility move, up 16 of 18 weeks. The last time that happened was in 1970. So it's been a very long time since we've had such a slow volatility advance like we've had, such an extended one, and we're up 20% in those 18 weeks. So from the October lows, we're up 20%. Now remember, this run, of course, has built a lot of bullish exuberance in the markets. Everything is good, everything is positive. But remember that just in October, not too long ago, everybody was extremely negative. This decline had everybody convinced that the bear market had returned. We got into extremely negative territory in terms of sentiment, and that had followed that very big AI, this was an AI chase back in earlier last year. That AI chase into the peak in July, everybody was bullish just like they are now, because guess what? We're right back to that AI chase once again. But again, very two similar periods. We had periods where you had a very elevated and extended MACD buy signal. And again, that MACD level is very high. This is the point, though, that I want to bring out. Take a look real quick at how long that this MACD has been kind of flatlining at a very high level. I had to go back a good ways to see a period that's been very similar to that, and this is what we found. So again, you had this period of very high elevation that was sticky. And again, this is the thing, right? We've been to these periods where we've had very high levels of this MACD signal before, right? So, you've had these periods where markets got very exuberant. You eventually had the correction. But there's been very few periods where it was sustained at this very high level. We have to go back to look at periods like post-2008. So again, this is 2009, QE1, TARP, HAMP, HARP. We're just fueling the markets with just all kinds of goodness here. Very extended run, not much of a correction, and then we got into a fairly decent corrective cycle in the markets following that period. Going back prior to that, at not quite as high of a level, but getting there, was the run in the market, very low volatility, heading into the peak right before the financial crisis itself. Since then, we really haven't had periods that were sustained at a very high level. We've had spikes in volatility, spikes in the markets that eventually led to some type of corrective action. But there's been very few periods where it's been this sustained for this period of time. And ultimately, every one of those periods where it's been that sustained for that long, it led to a more corrective outcome in the market. So again, not saying that's absolutely got to occur, nothing to panic about, but something certainly worth considering when you're taking a look at where we are in terms of just this extended period of the markets being very overbought. You have a period of declining momentum in the market that's also a negative kind of for a sustained move. Momentum is starting to drag here a bit. So again, not saying that markets are going to crash, but again, expecting some type of corrective action to reverse some of this overbought condition certainly should be expected at some point between now and the election. So just making you aware of that. That's what you need to know before the bell this morning. So when we come back, though, I want to talk a little bit about Warren Buffett. Not this past Saturday, but Saturday before, Berkshire Hathaway released their annual letter. He made some very interesting comments about his $160 billion in cash and his trouble in deploying that. So when we come back from the break, we'll talk about what he said and what that potentially means for the markets and investors. Don't go away. More of The Real Investment Show coming right up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, as I said, not this past Saturday, but Saturday before last, Warren Buffett, Berkshire Hathaway, delivered their annual letter. And of course, this is, the event of the year for Wall Street. People have been reading this for over 50 years, I think now. And, it's always full of, wisdoms and investing ideas, etc. And of course, this year, just like every year, he made some important points. And one of this was talking about his $160 billion cash pile. And, this is interesting because this has a couple of important points relative to some of the market kind of themes that we see running around, kind of out there in the world right now. But if you take a look at a chart of his cash balance. This is something that's been accruing now for quite some time. And you can see at periods where he was able to make an acquisition or something, you see a drawdown in the cash balance. But outside of that, the cash balance is just kind of keep growing. And if you take that $160 billion and just put this in terms of GDP, right? Warren Buffett's cash pile would make him the 59th largest country in the world in terms of GDP. He would be larger than Kuwait. So, this is just, how much cash that actually is. And it's just a tremendous cash pile. But he makes this comment importantly in his statement talking about, why he has this inability of cash. But importantly, this is one of the myths, though, that needs to be broken up. You hear a lot in the news right now about the $6.4 trillion in money market accounts. And we've had this conversation on the show before, and people go, it's like all this money is just sitting there in money markets. Is going to come flying back into the market, and this is going to be a tremendous thing. As we've said before, look, for every buyer, you have to have a seller. It really doesn't mean anything. But importantly, when you take a look at the breakdown of those cash balances, you're going to see something very interesting. And what you see is that a very massive part of those cash balances are called institutional money market funds. These funds generally have $1 million minimum to get into them. So this is not something most retail investors are using. In fact, looking at this chart, that little sliver of yellow at the bottom, those are retail money market funds. So there's certainly some cash there, but a massive chunk of this belongs to institutions. So $160 billion for Warren Buffett, $80 billion for Apple, just these massive cash hoards that these companies are holding right now are very important. And again, if you take a look at the actual value of cash and short-term assets that are owned by corporations, they own about $4.2 trillion. So of that 6.4, about 4.2 trillion belongs to corporations. So again, that just kind of jives with all that data. So it's just, that's one of the myths. Now, that money's never going to come into the market. Money's not slated for the market. It's slated for operational expenses. It's slated for buybacks. It's slated for a whole variety of issues that have nothing to do with stock, just operations, capital expenditures, R&D, acquisitions and mergers, all those type of things. And so, that's what that cash is used for. And of course, as we've talked about before, since 2009, buybacks have been a major use of that cash for companies. And we just keep seeing this expanded surge in the amount of buybacks being done by corporations really since the financial crisis in order to meet EPS and really kind of lack of better alternatives. And that lack of better alternatives was the main point of Berkshire's statement. And when Warren Buffett was talking about this, he said, there's a reason why we're not deploying all this cash. And just real quick, before we get to that, let me back up 1 second about this on this chart of buybacks, because he made a comment about buybacks as well. Warren Buffett has done buybacks, but he doesn't do them at the rate that companies like Apple are doing them, which we just wrote an article on our website, Michael did, talking about the massive amount of buybacks that Apple has done. And Warren Buffett said, such repurchases increase your participation in an asset that Berkshire owns because there's less shares outstanding. To this obvious but overlooked truth, I add my usual caveat. All stock repurchases should be price dependent. What is sensible at a discount to business value becomes stupid if done at a premium. The problem with most of these buybacks that we're talking about is they're done at premiums. These aren't done at discounts. They aren't done at accretive levels. And so eventually when the market does have a downturn, you run into a much bigger problem. Okay, so here's what Warren Buffett said about his cash. He said, quote, there remain only a handful of companies in this country capable of truly moving the needle at Berkshire, and they have been endlessly picked over by us and by others. Some we value, some we can't. So what he's saying is that when you have $160 billion in cash and you've got a company that is the size of Berkshire Hathaway, you have to buy big companies. If I go buy a $100 million company, it does, great, I spend $100 million. I got $160 billion to spend. I spend $100 million or even $1 billion on a company. It's too small. It just doesn't do anything for the cash balance sheet or for the operating balance sheet of the company. So, I can buy $1 billion. I can stroke a check today for 16 $1 billion companies, right? And it's just, 160 $1 billion companies. That's how much money he's got. So, it just doesn't move the needle for him. He's got to buy a big company. He needs a, and he said, I'll use this as an example, but you got to buy an Occidental Petroleum. He said he'll never buy all of Occidental. He says the CEO, she does a great job running the company. She knows how to drill for oil and gas. They want to participate in that, but they don't want to own the company. But the point would be is that you need to buy a company that size and something that can really grow in order to meaningfully move the needle for Berkshire. But the caveat to this statement, he said these companies that are out there, we've picked them over, we can't value them, some we can, some we can't, but they're not a good value, is what he's saying. He says this, he says, and if we can value them, they have to be attractively priced. So in other words, these companies they're evaluating that they're not buying, these companies that are large enough to move the needle, they're not attractively priced. And that's really kind of the key issue that's going on for Buffett and for Berkshire. So if the economy is doing great, and if these companies are growing at the rate that they're supposed to be growing, right, valuations are a problem with the current prices of those companies. But unfortunately, we're not seeing that type of growth. In fact, if you take a look at CapEx plans, think about this for a moment. I've got $160 billion to spend, right? Capital expenditures, yes, I can do stock buybacks, which benefit insiders. They don't really benefit stockholders that much. But I could spend that money on building out property, plant, equipment, et cetera, but CapEx isn't really growing. So companies aren't really spending money on CapEx or real private investment because it takes too long to create value and the opportunity isn't there because the economy is not growing strongly enough to support that type of investment. So this leads to, the problem with capital investments is that they take time to generate a profitable return that accretes to the business bottom line. The same goes for acquisitions, right? So I'm going to buy a company, that takes a lot of time. So they must be accretive to the company. They must be at a value, and that's Warren Buffett's point. Right now, there's not value to the company to make these purchases. In other words, if I'm going to spend this capital, I've got to overpay for an asset just to try to liquidate capital, and that makes no sense. And this kind of brings us to Warren Buffett's favorite measure, which is market cap to GDP. And currently, the market cap to GDP is running at about 2 times market cap to GDP, and that makes no sense because the earnings and revenue grow at the rate of economic growth. So at 1 times market cap to GDP, right, you're paying exactly what the economy can generate. So if you want to buy something cheap, you've got to buy it at less than the value of market cap to GDP, so less than 1. But you're paying 2 times that now. So you're paying today for 2 times what the actual economy can generate. And that's Warren Buffett's big problem, is that I can't allocate that type of capital at those valuations. And look, you can prove this out. If you take a look at GDP versus the S&P 500 versus earnings growth, you can see that there is a long-term trending correlation between these. When earnings are grossly above GDP, you typically get a reversion in earnings below GDP, right? We haven't had that occur yet, but that's normally what happens. Back in 2020, we reverted to GDP, and then we did $5 trillion worth of stimulus, which shot earnings back up again. So we never got that reversion. But normally, when you have GDP running at a very high level above GDP, it eventually reverts because, again, earnings can't grow faster than the economy for extended periods because the economy is where the earnings come from. So coming out of a recession, yes, earnings can grow faster because everybody's ramping up spending, et cetera. But then things are going to revert. But the market, when the market trades this far above GDP growth historically, you have really, really big corrections at some point to revert that valuation. And at 2 times market cap to GDP, that's certainly a problem. We'll finish this conversation up on the other side of the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I learned a very valuable lesson yesterday, Brett. My wife had a really hard day at work, and she came home, and she was a little bit stressed out. And I said, well, honey, I'll take you to go get a scoop of ice cream. She said, no, I can't. I'm too fat. That's where I made my critical mistake.
The Real Investment Show podcast.
I said, okay.
Same show, your schedule.
Then I realized at that moment that I'd made this crucial mistake, which was I should have said, no, you need to get 2 scoops because you're too skinny.
At realinvestmentadvice.com.
You need some ice cream. Go eat a cheeseburger.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. Talking a little bit about Buffett's $160 billion dilemma, which is that, he can't deploy it because valuations are ridiculous for Warren Buffett to buy companies. And it's interesting because just for the break, we were talking a little bit about this correlation, this long-term trending correlation between the market, earnings growth, and GDP. And when the market and earnings are trading well above GDP on a cumulative growth rate, then you eventually get reversions back down below that. And here's the important part about this. So let's take a look at market cap to GDP as it relates to the inflation. I'm going to change charts, Brent. As it relates to the issue of the price of the market. So if you take a look at a correlation between the market cap to GDP ratio and the inflation adjusted price of the S&P, there's a very high correlation, obviously, right? If you overpay for something, you're eventually going to have, a lower rate of return. And so the price is going to move lower at some point. So when you take a look at periods where, we've had very big outsized moves in the markets, that dot on the very far right-hand end, where it's the 22 correction. That was the peak of the market just before we corrected 20% in 2022. So currently we've got another period where we're very far outside that valuation range, right, relative to the price of the market. So you should expect at some point either lower rates of return, or, well, you're going to expect lower rates of return because you've got to revert at some point that valuation issue. And so this is his point. And we can look at this a couple of different ways. We can look at this valuation problem a couple of different ways. One is to look at the cumulative change in the inflation-adjusted S&P 500 versus profits, real profits, inflation-adjusted profits for companies. So this is just corporate profits after tax. Again, the market is trading well outside what the profits of companies are actually creating. This is a cumulative basis, so these are matched metrics. And whenever you can see, during the dot-com bubble, the market traded well outside what profits were generated. Same thing in the financial crisis. Periods where you had really great opportunities to buy assets were just after the financial crisis back in the early 1980s, after the 74 crash, because that's where the market was trading below the profitability, right? So you're buying stuff at a discount. And this is where Warren Buffett made a lot of his money with the companies that he was buying back then. If we take a look at a little different way to look at that same data, so we look at the real S&P 500 price to the price to profits ratio. And again, we kind of see the same issue. If you take a look at the price of the market, profit, the price to profits ratio trading well above its mean. So again, we go back to this kind of issue of overvaluation. And again, none of this should be surprising considering that this is kind of where we are. If we take a look at the correlation between the price of the index and that profits to GDP ratio, we get this very similar type of analysis that suggests that, we're very far stretched out on that valuation curve of what we're paying, and you're eventually going to have some type of reversion in the markets. Now, this doesn't mean tomorrow, next week. It doesn't mean, anything is going to occur over the course of the next, 2 days, 3 days. So, you just don't go sell everything and move to cash. But it's something certainly worth considering. And look, if we just look at the index since really 2008, we talk about all this monetary intervention, right? We've had zero interest rates. We've had, QE1, QE2, QE3. The market's trading well above its 24-month moving average, something that it doesn't typically sustain for very long once it begins to get this deviated from that moving average. But we're in that period where we have, rapidly loosening financial conditions, even though the Fed's not cutting rates yet. And even though the Fed's still doing QT, we have these rapidly reducing, kind of monetary tightness is being wrung out of the market, and we have all this liquidity that's showing up. So again, this deviation from the 24-month moving average is is not surprising, right? Because of what's going on in this kind of bubble attitude. But it's important to understand that eventually it will correct. And as we always have at some point corrected back towards that moving average. And, right now, if you just kind of eyeball that's somewhere around 4,000 on the index. So, you could clip off 1,000 points on the S&P pretty quickly. And, it sounds like a lot. It is. It's a 25% correction. But, sorry, a 20% correction. But that wouldn't be outside the realm of normality, right? But that would fix some of that over. But that doesn't mean we can't go a lot higher first, right? Before we eventually have that correction. But this is, the point ultimately of what Warren Buffett was talking about in his dilemma with his cash pile. And this was a point that he made specifically in his letter, when talking about this. He says, occasionally, markets and or the economy will cause stocks and bonds of some large and fundamentally good businesses to be strikingly mispriced. Now, what does he mean by that? He means that at some point you're going to have a correction to where an event occurs that creates a underpricing of assets relative to their value. And his point was look, we've got $160 billion in cash. When something happens, we can go cut deals like he did in 2008 during the financial crisis. He cut an amazing deal with Goldman Sachs to give them money, and he had 10% preferred stock issued to him. He made a killing on that. But he's in a position with his cash and his credibility in the markets and his institutional relationships that if somebody gets in trouble, they'll call up Warren Buffett and say, hey, Uncle Warren, I'm in trouble. I'm going to give you a hell of a deal to give me some money. And he'll cut a deal. And that's his point he was talking about. He says, indeed, markets can and will unpredictably seize up or even vanish as they did for 4 months in 1914 and for a few days in 2001. If you believe that American investors are now more stable than in the past, think back to September of 2008. Speed of communication and the wonders of technology facilitate instant worldwide paralysis, and we have come a long way since smoke signals. Such instant panics won't happen often, but they will happen. And that's just something to consider. When you're paying as much as you're paying today for assets, something typically tends to happen that causes this mean reverting event. Now, again, that doesn't mean today. It doesn't mean next week. It doesn't mean next month. It doesn't mean this year. It doesn't mean next year. It could be 3 years from now. It could be 5 years from now. And this is the problem with trying to predict these outcomes, is because you can say, well, I heard Lance talking about market cap to GDP. I'm going to go to cash. That's a terrible idea right now. Because ultimately, this market can remain irrational much longer than you can remain solvent. What happens, and I got an email over the weekend, like, I've been in cash for a long time, and I'm trying to figure out how to get back into the markets. How do I do that? And it's like, you just have to kind of dollar cost your average your way back in, because timing the market, this is always the problem with trying to time the market, being all in or all out. That's timing. It's impossible to do. And once you get on kind of the wrong side, right, I'm out. I'm going to wait for this crash, and the crash doesn't come. Remember in 2022, everybody was expecting the market was going to have this major 50% crash. We're going to have a recession, and it never occurred. So now everybody that got out in 2022 going, hey, this was supposed to happen, it didn't happen. Now they're way behind the curve. Now they got to try to figure out how to get back in. So as investors, what we have to do is understand the risk. That's the whole point of this article this weekend in the newsletter, was to understand the risk of valuations and what that means. And apply that to understanding that I know there's this risk that's out there. I've got to be aware of it. And when I began to see the market recognize that risk, I have to leave. But we're not there yet. Saw an interesting graphic out this morning. The number of custodial accounts, these are accounts for children under the age of 18, are surging. Parents are opening up accounts for their kids. because their kids have been online on TikTok and they're learning all about gambling in the markets, and they want to, go buy NVIDIA stock in their account or, whatever. And so they're opening up these custodial accounts, and this is a great idea. I think we should all teach our kids how to invest. The problem is we don't teach our kids how to invest. We teach them how to gamble. And if we taught our kids to invest properly, we teach them to buy an S&P index, to dollar cost average into that index with their allowance money, etc., not buy individual stocks, not buy meme stocks, not buy these stocks that are just going to the moon that they're reading about on Reddit without doing any research. We're teaching them to gamble. And the problem with that is that we will have another event like the financial crisis where you devastate an entire generation of people that never come back into the markets to invest ever again. A lot of people who went through the financial crisis never came back. All these kids that started gambling during post-pandemic, they've never seen a bear market. They don't know what it does to your wealth. And when you lose all your money from a crash, you typically don't come back. And this happened with investors after the 1974 crash. They never came back. After 1929, they never came back. So again, the markets are a very brutal teacher ultimately. We need to be careful with our children to make sure we're teaching them to actually invest and save, not gamble. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So just with a break, talking a little bit about speculation in the markets, retail investors, and I was talking about on Friday that retail investors are making all the same mistakes all over again. And we saw this, back in 2021. Lots of exuberance in the markets, and of course, 2022 came along, and a lot of the meme stocks that they were investing in crashed, destroyed a lot of wealth. And we wrote some articles about these kids that had, millions of dollars and they lost it all. Bitcoin crashed, the meme stocks crashed, kind of everything crashed. And they are back. But interestingly enough, retail investors have not even got back to even yet. And in fact, if you take a look at this chart going back to January of 2020, retail investors have been underwater for a long time. So even though the markets are making new all-time highs, they haven't got there yet. And this is because they take on too much speculative risk. They don't manage that risk properly. And ultimately, it creates problems. So if we take a look at a couple of other charts here, we're going to see some kind of very similar themes, even really to what we were just talking about with Warren Buffett. But, this is an index of what we call smart money and dumb money. So smart money is institutions, dumb money is retail investors. The reason, hold on, sorry, my chart changed on me, didn't mean that to happen. The reason they're called dumb money is you have to remember that Wall Street sells product. The retail investor is the consumer of that product. So Wall Street is not on the side of the consumer, right? Wall Street creates product, they sell it to you. So institutions, in order for you to buy something, somebody has to be selling. Generally, you're buying from the institution. The institutions are going, hey, I'm selling this, I'm selling equities, right? Retail investors are buying them. So they're bringing in their cash, they're selling them to you. And so whenever the dumb money index starts to reach higher levels, that typically corresponds with corrections in the markets. Obviously, not surprising because that's generally where institutions are beginning to sell to that. And we take a look at the dumb money less smart money kind of measure of this. So we just take a look at that same data and we split it out. Whenever dumb money less smart money is at a peak, as we are now, again, same idea, you typically tend to be near the peak of a market. So in other words, the dumb money typically is buying stocks. Institutions are selling that near market peaks. And we see the same, we see that in real time with the American Association of Individual Investors, which are metrics that measure the retail investor, and they're piling into equities. They're increasing their equity exposure back towards historical high level, high points. Cash and bond exposure remains extremely low. And that's not surprising because of the whole sentiment in the markets right now that this market could go, only higher from here. There's some other measures that we can look at as well. Retail flows into stocks at very high levels. This is not surprising. Again, you take a look at the sentiment indexes right now. Consumer sentiment is running very high at the moment. By the way, there's a very close correlation between consumer sentiment and valuations. Call options. Of course, the most speculative type of investing by retail investors. This is pure gambling, right? These are binary outcomes. I either make money or I have zero because options expire worthless. So I either lose all my money or I make a bunch of money. That's very much a binary bet. That's the same thing as going into Vegas and betting on black, right? I either win or I lose. And that's what options are. That's not investing. That's gambling. Investors chasing small cap stocks right now. The most susceptible stocks to a slowdown in earnings growth or a revert or higher inflation or the Fed not cutting rates, but everybody's piling into small caps, the most risky generally of the investment world, right? A lot of volatility and very dependent on, we've talked about the risk to small caps in last week's newsletter, but again, you just see this very big problem. And again, talking about small caps in particular, corporate debt is surging, even as GDP is falling, right? So we've had this massive surge in GDP, which was great. So that was due to all that stimulus money. But as GDP slows down, companies are having to ramp up more debt just to keep business going. And in a lot of cases, in particular, with small cap companies, and our friends over at Kailash Concepts did a chart for me, but this is the percentage of the Russell 2000 index that have basically negative earnings. It's almost 40%. These are the companies that have to issue debt in order just to sustain their business because they don't generate enough earnings. They have negative earnings growth. So again, it's just, these are just the issues right now with the retail market. And again, where they're speculating, the things that they're speculating on, this is where the problem comes. And again, it's great. I think that, as I said before, I think it's great that parents are teaching their kids to invest, but we need to teach our kids to invest correctly. Start out, open them up a custodial account. I got no problem with that. All right. You match them on whatever they save up. So look, tell them, they're going to earn their allowance, and make them work for their allowance. Just don't give kids allowance. Make them do something for it, right? Make them learn the value of work versus the revenue that they earn. And give them a reason to save it rather than to spend it, right? So for every dollar you save, I'm going to match you $1 or $2, whatever you want to do, and open up an account and buy an S&P index fund. And then teach them to watch the fund. And when the fund goes up in price, explain to them why this is going up, right? The economic data is good. Earnings growth is strong right now, those type of things. When it goes down, explain to them why it's going down. Don't worry about teach them to buy or sell. Teach them to hold it, but explain it to them in terms of things they can understand about why things are doing good or things are doing poorly. And that when things are going down, you buy more of it, right? Teach them to save. Teach them to invest. Now, once they get older and they have a better grasp about economics and what's going on, then you can teach them about individual companies, how to value an individual company, how to look at revenue growth, how to look at earnings growth, how to look at the value that the company generates. And then you can teach them to start investing in individual companies. But they need more capital for that as well, because a lot of these companies trade at fairly high levels. But teach them the value of investing and saving, right? This is the problem I have with these schools. And I regularly get phone calls, and this generally happens during, these phone calls evaporate during bear markets. But during bull markets, especially more speculative ones, and these emails and phone calls have picked up lately, but I'll get a call or an email from a teacher saying, "Hey, I'm teaching a class," or I'll get a call or I'll get an email from the students. They're in a class and they're gonna have a contest about the stock market over the course of the semester. So over the next 8 weeks, they're gonna buy. They've got an imaginary amount of money to buy stocks with, and whoever does the best wins. That's just teaching your kids to gamble, right? You're not teaching them to invest. What happens over the course of a quarter or 8 weeks is meaningless. If you want to teach a class like that to your kids, if you're an educator listening to the show right now, I appreciate what you do. But don't teach your kids to gamble. Teach them to invest. Over the next 8 weeks, we're going to buy some stocks, but we're going to buy stocks based on earnings and valuations, and I'm going to teach you how to value a company. We're going to look at the balance sheet. We're going to look at the income statement. We're going to look at sales growth on a year-over-year basis. We're going to look at price to sales ratios, price to earnings ratios. Teach them to invest. Teach them to evaluate. That's a good class. Don't teach them to gamble. It's not a competition. Investing isn't a competition. It's not about who wins or who loses. It's about growing your capital over time. What the market does is irrelevant. So teach them the values of investing and teach them the importance of investing and teach them about the risk that come along with markets. And you'll do them a favor. You will create a better environment for them in the future. And if you don't understand how to do that, call me. I'll come help you. We'll teach a class. Because it's not hard. But these are the things that I teach my children, right? And it's not complicated. And again, it's not exciting. And you're not going to, buy a stock that goes, through the moon tomorrow. You might, but those are the things that you want to teach them. And that's what they'll learn from. Anyway, this is kind of an annual soapbox that I get on, because every time we get into one of these kind of meme markets, this is where it all pops out, and this stuff always starts again. And it's always by the way, that's always a really good indicator that we're probably closer to a corrective phase than not. Because when I start getting a lot of emails like I'm getting now about these stock market classes type thing, that generally occurs within 6 to 8 months of a market peak. Last time I was getting this was in March, April, May of 2021, by the way. And then they evaporated. So anyway, as you just kind of look at the markets. Again, we're going to open up the markets. We're running out of earnings. There's no economic reports out today of any consequence to move the markets. You got GitLab, Stitch Fix, Thread up today. Again, not major companies reporting today. That's all. 90% of the S&P is done. So we're going to be focused pretty much back on economic data this week. Tomorrow, we've got a good bit of it. Global U.S. services, PMI, February final, ISM services index is tomorrow. We've got durable goods tomorrow. So again, there's some economic data that could move markets if those come in either stronger or weaker than expected. So anyway, we'll keep you up to date. Have a good day. We'll see you back here tomorrow for the next edition of The Real Investment Show. If you've got any questions or comments, get by the website, realinvestmentadvice.com. Our latest newsletter is out. We went through today. If you want all the charts, they're in that index along with Friday's blog post, all at the website, realinvestmentadvice.com. Have a great day.